And welcome back. We'll be discussing life insurance contracts. By the end of this lesson, you should be able to discuss many of the standard provisions within a life insurance policy, describe some of the most common riders used to customize life insurance contracts. So first we'll talk about the parties to a life insurance contract. We have the insurance company, the insured, the policy owner, and the beneficiary, which typically has a contingent right if revocable. The life insurance contract is a contract of adhesion, and the policy owner and the insurer do not negotiate the contract's terms. Rather, in the creation of a life insurance contract, the prospective policy owner fills out the application and supplies the evidence of insurability. Based on this information, the insurer decides whether or not to issue a policy, and in conjunction with that, accepts or rejects the contract offered by the insurer by paying or failing to pay the initial premium. Some of the standard policy provisions in life insurance. One is the entire contract clause, incontestability clause, ownership clause, beneficiary designations, payment of premium, grace period clause and reinstatement clause, policy loans, dividends, settlement options, and others. So here we go. The entire contract clause states that a life insurance policy and the attached application constitute the entire contract between the parties. In the prior PowerPoint lecture, we went over this. Again, it's the physical application itself becomes part of the contract at issuance of the policy. The incontestability clause states the insurer cannot contest the policy after it has been enforced 2 years during the insured's lifetime. So, for example, some of the exclusions in the policy are suicide. If the insured commits suicide within the first 2 years, the insurance company cannot, within the first 2 years, the insurance company can contest that and just refund the premium paid and not issue a death benefit. After 2 years, if suicide happens, the insurance company cannot contest that. They will have to issue payment. The ownership clause. The policy owner possesses all contractual right in the policy while the insured is living. The policy owner can be the insured, a beneficiary, a trust, or another party. And some of the contractual rights include naming and changing the beneficiaries, surrendering the policy, borrowing the cash value, receiving dividends, and electing settlement options. With regard to beneficiary designation, the beneficiary is the party named in the policy to receive the policy proceeds. And there's typically primary and contingent beneficiaries. Most life insurance contracts, you'll see primary, successor, and final as terminology used, so first, second, and third. If the first beneficiary is dead at the point of the death benefit being received from the insured, it would go to the successor or contingent beneficiaries. If they are passed on, it would go to the final beneficiary. If all classes of beneficiary are dead, the life insurance proceeds would go to the estate of the insured. If they had a will and trust, it's possible it could avoid probate. If they died intestate, it will have to go through probate. Continuing on with beneficiary designations, a revocable beneficiary is one that can be changed at any time in the future by the policy owner. And they do not have to receive notice of being beneficiary or being excluded or changed away from being the beneficiary. We have an irrevocable beneficiary. That means the policy owner cannot change the beneficiary designation without the beneficiary consenting to that change. We have specific beneficiaries. It means the beneficiary is specifically named and identified. So for example, to my children, Sally and Tommy in equal shares. That would be specific. A class beneficiary means a specific person is not named, but a group designated by the insured. It could be the beneficiary could be my trust, and then once the death proceeds go to the trust, the will and trust will dictate how that money comes out to specific beneficiaries. Some of the standard provisions in life insurance contracts is the payment of premiums. They can be paid annual, semi-annual, quarterly, or monthly, and in some cases they can be paid years in advance. For example, in California, you can prepay your life insurance premiums for 10 years in advance. In the state of Texas, in contrast, you can prepay 15 years in advance. So if you have an affluent client who wants to be one and done, so to speak, on a limited pay life contract, such as a 10 pay life, 10 annual payments and the policy's paid up, in California, they could write you one check and be done, in essence. Typically, the insurance companies will discount the future premiums by a stated percentage, 4-5% being common at this point in time. Moving on, we have the grace period clause, stating the policy owner has 31 days to pay an overdue premium. Universal life and other flexible premium policies usually have a longer grace period. Whole life usually has an APL, automatic premium loan provision, so that if the premium is failed to pay, and if that is indicated on the contract, any cash values will be used to sustain the policy as long as possible. There's also a reinstatement clause, permits the policy owner to reinstate the policy provided certain conditions are met. One being they pay the premium, two being they are still healthy and meet underwriting requirements. It's a convenience clause in essence because it doesn't require additional underwriting, additional applications. They're also typically very limited in nature. You might see 60 or maybe 90 days at the most with most insurance companies. Policy loans. On cash value policies, policy loans can apply. These provisions govern how the policy owner can borrow cash from inside of the policy. Typical provisions include there's no credit qualification and typically limits up to 90 or even 100% of the cash value of the policy. There can be a fixed or variable interest rate. That's at the discretion of the life insurance company and also stated in the contract. Any unpaid interest is added to the loan balance annually, and there is no repayment schedule or requirement. When the loan is repaid, when the policy is surrendered or upon death of the insured. Let's talk about that for a second. When you look at life insurance companies' financial statement and look how they're invested, typically you'll see bonds for the most part, a little bit of equities, you might see real estate, mortgages, and policy loans. So there is a zero default rate with policy loans. Why is this? Simply stated that the loan will always be repaid. If the policy is surrendered while living, the cash value is subtracted from the loan balance and the insurance company receives the full amount back. If the insured dies, the death settlement will subtract out any loans from that policy benefits before the estate receives the death benefit proceeds. So again, it's zero risk to the insurance company, and also from an investment standpoint, the policy loans typically are much higher than the prevailing interest rates on bonds. And the last bullet point, this may include an automatic premium loan feature. I mentioned that will be on the application typically for a whole life policy. Now we have some dividend options. Policies that pay dividends are known as participating policies. Those that do not pay dividends are known as non-participating policies, meaning they're participating in the profits of the life insurance company. Dividends can come in several forms. They could be cash, where the policy owner receives a check every year on the policy anniversary. They can be a premium offset, where they reduce the next premium coming due. Generally speaking, dividends always increase with each successive year in the policy that it's in force. So, for example, if the premium is $400 a year and the current year's policy dividend is $60, well, if they elect that option, the new bill would be $400, the premium due, minus the $60 dividend that's been applied. So they would have $340 in that example. And next year it might be a $70 dividend. So again, as the dividends grow, we get closer to having that premium totally offset at some point in the future. Next type is paid-up additional insurance, or paid-up additions, where the dividend is used to purchase a small amount of paid-up whole life insurance. So it's a single premium purchase, and it adds to the death benefit of the policy. And the last is a fifth dividend option. The dividend can be used to purchase 1-year term insurance equal to the cash value of the basic policy, and the remainder of the dividend is used to buy paid-up additions or is accumulated at interest. Now some settlement options. These options refer to the various way policy proceeds can be paid rather than a lump sum. One is the interest option. The policy proceeds are retained by the insurer, and the interest is periodically paid to the beneficiary. Next is the fixed period option. This is basically annuitizing the death benefit proceed for a fixed number of years. And as the slide says, the policy proceeds are paid to a beneficiary over a fixed period of time. There's the fixed amount option, where the policy proceeds are paid to the beneficiary in a fixed amount over some period of time. So let's say, for example, there's a $100,000 death benefit, and the beneficiary says, I'd like to receive $800 a month. So that beneficiary will receive the $800 until the entire death benefit is exhausted. And along the way, typically interest will be added to the undistributed portion of the death benefit. More on settlement options, we have life income options. The policy proceeds are paid to a beneficiary over a specified lifetime. Available lifetime income options are the life income. Installment payments are paid while the beneficiary is alive and cease on the beneficiary's death. Again, basically annuitizing based over their life expectancy. Or the life income with period certain. Like an annuity, it would pay installments while the beneficiary is alive with a certain number of payments guaranteed. So let's just say 20-year period certain, and the beneficiary dies at year 13. Well, the beneficiary's estate would then receive 7 additional years of payments, and that would make 13 plus 7 the 20-year guaranteed period. We have life income with refund. Installment payments are paid while the beneficiary is alive. If the beneficiary dies before receiving payments equal to the amount of insurance, the difference is refunded in installments or a lump sum to another beneficiary. And we also have joint and survivor income. Payments are paid to 2 persons during their lifetimes. So again, a lot of these resemble annuities because you are basically annuitizing the death benefit. Some other standard provisions in the contract. Misstatement of age or sex clause states that if the insured's age or sex is misstated, the amount payable is the amount that the premium paid would have purchased at the correct age or sex. So again, if male was indicated instead of female, or vice versa, if age 46 instead of age 64, one of those examples, the benefits would be adjusted accordingly. Change of plan provision allows the policy owner to exchange their present policy for a different contract. Most typically, you'll see term policies that have a change of plan provision called a convertibility clause. They can convert all or part of that term policy to a permanent policy, whole or universal life, at a time specified within the contract. I've seen insurance companies go for the life of the contract. I've seen insurance companies go for a fixed number of years, such as 10, and I have seen insurance companies go to a stated age. So it just depends on the company. Automatic premium loan provision, we've touched on this prior, allows overdue premium to be borrowed from the cash value after the grace period has expired. Exclusions and restrictions. Most policies have few exclusions and restrictions. Suicide is excluded only for a stated period, typically 2 years, and some undesirable hobbies like skydiving, rock climbing, scuba diving may be excluded. There's also a suicide clause stating that if the insured commits suicide within 2 years after the policy is issued, the face amount of the insurance will not be paid. The beneficiary will only receive a refund of premiums. Last, we have the assignment clause, which allows the policy owner to freely assign the policy to another party. And there's a couple different types here. One is absolute assignment. All ownership rights are transferred, and that is irrevocable. The insured or the owner, current owner, is giving up all future ownership rights. Next is collateral assignment. Life insurance policy is assigned as collateral for a loan. Again, the Small Business Administration, they will request but not demand, in some cases, that life insurance be purchased if the borrower does qualify for life insurance. For the borrower, it gives a couple benefits. One, it makes qualifying for the loan easier from the SBA. And two, if the policyholder were to die, the SBA receives the first proceeds, paying off the loan and unencumbering the business. So the family or the other beneficiaries receive that business debt-free. And if there's any residual left over after the loan is paid, the beneficiary named by the insured would receive any residual of that. Non-forfeiture options. Usually found in cash value policies, this provision determines the form of value the policy owner will receive if he surrenders the policy. And there are three typical options. The most common being the cash value. The policy is surrendered, and any cash value net of surrender charges is given back to the owner. Next is reduced paid-up insurance, where the cash surrender value is applied as a net single premium to purchase a reduced paid-up policy. So for example, a $100,000 whole life policy that's surrendered 12 or 13 years in the future, the cash value at that time would be used to purchase a smaller whole life policy that is paid up. No other premiums would be due. And the last would be extended term insurance. The net cash surrender value is used as net single premium to extend the full face value of the policy into the future as term coverage for a certain number of years and days. And that term is calculated by the insurance company based upon the prevailing cost of the term insurance. Some of the common riders that we see. First is waiver of premium. If the insured becomes totally disabled before some stated age, all the premiums coming due for the period of disability are waived. This is important because while you're disabled, typically your income goes down. And if you were to die while disabled, it's potentially there could be unforeseen medical bills in conjunction with the disability on top of the normal expenses that the family would incur. So it is an important provision and is relatively inexpensive. Next is the guaranteed purchase option, also known as guaranteed insurability option. It permits the insured to purchase additional amounts of life insurance at specified times in the future without evidence of insurability. Generally, you'll see this on younger people. I know of one company that between ages 17 and 49, there are 11 option dates, and the maximum amount of coverage that can be purchased on this rider is $50,000. So let's just say the parents bought a small whole life policy, $50,000 for their child when they were born, with the intent of giving that policy to the child when they become an adult. Well, we don't know our future as far as health goes. That kid could contract diabetes via autoimmune disorders, juvenile diabetes. It could get cancer, any sort of disease that would otherwise prevent it from purchasing life insurance in the future. And those diseases might not necessarily kill them, but allow them to live a long life. Go to school, get a job, have a career, earn money, have the normal needs of anyone else, but they can't get life insurance. Well, because of having that guaranteed purchase option, regardless of insurability, they will be able to purchase at specified dates. The company gave an example of those 11 dates are roughly every 3 to 4 years. And so that insured would be able to just re-up and add to their policy. So a $50,000 policy could become $600,000 of coverage if all those guaranteeability purchase options were executed. There's also a time limit on those. Typically on those purchase options, it is 90 days before the anniversary date. So that's, again, the window of opportunity, and the policyholder is notified by the company and their agent. Another rider here, accidental death benefit rider, doubles the face amount of the life insurance if death occurs as a result of an accident, also referred to as a double indemnity clause. Other riders, we have a cost of living rider, allows the policyholder to purchase one-year term insurance equal to the percentage change in the consumer price index with no evidence of insurability. And accelerated death benefits allows insureds who are terminally ill or who suffer from certain catastrophic diseases to collect part or all of their life insurance benefits before they die, primarily to pay for the medical care that they require. The right may be provided as part of the policy or by rider. Regarding life policy replacements, from time to time, policy owners replace the old policy with a new one. Most of the time, there is a legitimate purpose, and quite frankly, there should be a legitimate purpose behind the decision to replace one policy with another, including that the owner's financial situation changes, so supporting that. They may have had a whole life policy that was several $100s a month, but due to a layoff and inability to return back to the prior wage level they were earning, they still have the same need, but they'll exchange it for a term policy to save money on premium but preserve the death benefit. Second being the policyholder's family situation changes, divorce being common, death being another. And the last being the life insurance market changes, making certain policies more attractive or more affordable. If the underlying cost of the life insurance decreases, the policyholder may be able to purchase or to replace that policy and pay lower premiums on the same amount of coverage. Issues for consideration when replacing policies are high first-year premiums, higher overall premiums, new or restarting the suicide clause, new or restarting incontestability clauses, and more or less favorable policy terms. There's a concept called twisting, and that is when the policy owner is induced to discontinue and replace a policy through the agent or the insurer distorting or misrepresenting the facts. So in summary, we've reviewed some of the standard provisions within life insurance policies, as well as riders that can be added to a life insurance policy. Thanks for your time.